Hey, welcome back. Here is something that has probably happened to you more than once. Price is moving along steadily, then suddenly, out of nowhere, it makes a massive, aggressive jump in one direction. A huge candle. No gradual build-up, just an instant explosive move. And then later, price comes back to that exact area where the jump happened, fills in that gap, and then continues in the original direction. You watched it happen and thought it was just normal market noise. Or maybe you tried to trade it but did not really understand why price was behaving that way. What you were looking at is called a fair value gap, and it is one of the most consistently reliable price patterns in all of trading. Fair value gaps are not some obscure concept invented by social media traders. They come directly from institutional trading theory. They represent moments when price moved so fast that the market became imbalanced. And markets hate imbalance. They have a strong tendency to come back and correct that imbalance before continuing the original move. Once you understand fair value gaps, you will see them on every chart you look at, and you will have a clear framework for trading them with precision. By the end of this video, you will know exactly what a fair value gap is and why it forms. You will know how to identify them on any chart. You will understand the difference between strong and weak gaps, and you will have a complete strategy for trading them with real examples. Let us get into it. What is a fair value gap and why does it form? Let us start with the foundation. A fair value gap is a three-candle pattern that forms when price moves so aggressively in one direction that it creates an imbalance between buying and selling pressure. Here is exactly what creates it. In a normal market, every price level that is traded has both buyers and sellers present. Price moves up a little, some buyers and sellers transact. Price moves up a little more transactions happen. Both sides of the market are participating at every level. But sometimes the market moves so fast and so aggressively that price skips over a range of levels entirely. It jumps from one price to another without adequate trading happening in between. In those skipped price levels, the market is imbalanced. There were almost no transactions. Buyers and sellers never properly met there. The price just blew right through without filling orders on both sides. That imbalanced zone is the fair value gap. Now here is why price comes back to fill it. Markets tend toward efficiency over time. When there is an imbalanced zone where the market did not have proper two-way trading, there is a natural tendency for price to return to that area. Institutional algorithms and smart money will often use that zone as a reference point. Unfilled orders from the original move may still sit within that gap waiting to be activated. The technical explanation is straightforward. The fair value gap is the range between the high of the first candle and the low of the third candle in a three-candle sequence, where the middle candle moved so aggressively that it created an overlap gap between those two outer candles. When price returns to that gap zone, it is filling the imbalance. And after the imbalance is filled, price often continues in the original direction of the aggressive move. How to identify a fair value gap on any chart? Identifying a fair value gap is simpler than it sounds once you know what to look for. You need three candles. Here is the exact process. Look at any three consecutive candles on your chart. Call them candle 1, candle 2, and candle 3. For a bullish fair value gap, meaning a gap that forms during an upward move, here is what you need to see. Candle 1 forms normally. Candle 2 is a large, aggressive bullish candle that moves up significantly. Candle 3 opens and trades above the high of candle 1. The key measurement is this. Look at the high of candle 1. Look at the low of candle 3. If there is a gap between the high of candle 1 and the low of candle 3, meaning the low of candle 3 is higher than the high of candle 1 and the two candles do not overlap at all, You have a fair value gap. That gap between the high of candle 1 and the low of candle 3 is the fair value gap zone. Mark it on your chart. For a bearish fair value gap, meaning a gap that forms during a downward move, the logic reverses. Candle 2 is a large, aggressive bearish candle. The high of candle 3 is lower than the low of candle 1. They do not overlap. The space between the low of candle 1 and the high of candle 3 is the fair value gap zone. Once you know this pattern, you will start seeing fair value gaps everywhere on your charts. They appear across every time frame, every market, and every asset. They are extremely common. And that frequency is part of what makes them so useful as a trading tool. Real examples of fair value gaps in action. Let me walk you through some real-world examples of how fair value gaps play out so you can see exactly what to look for. Example number 1. Bitcoin aggressive breakout followed by gap fill. Imagine Bitcoin is trading around $42,000. A major positive news event hits the market. In a matter of minutes, Bitcoin makes an aggressive move up to $45,000. A large single candle or a series of very fast candles. Looking at those three candles, you can see the gap between the high of the candle before the aggressive move and the low of the candle after it. That zone around 42,500 to $43,000 was barely traded during the explosive move. 2 days later, Bitcoin pulls back. It drifts back down toward that 42,500 to 43,000 zone. It enters the fair value gap. It slows down. Some consolidation happens within the gap. And then buyers step in strongly. Price reverses back upward and continues the rally. That pullback into the gap was the high probability buying opportunity that most retail traders either missed or were afraid to take because it looked like a reversal. Example number 2. Ethereum news driven drop and gap fill. Ethereum makes a sudden sharp drop from $2,000 to $1,800 after negative regulatory news. A fair value gap forms between $1,900 and $1,950, the zone that was barely traded during the aggressive drop. A few days later, Ethereum bounces back up toward that gap. It enters the 1900 to 1950 zone. Sellers step in at the gap. Price rejects from the top of the gap zone and continues downward. That gap acted as resistance. Traders who understood fair value gaps used that zone as a selling or short entry opportunity with a clearly defined risk level above the gap. In both examples, the gap acted as a magnet for price, and when price reached the gap, it provided a high-quality trading opportunity. How to trade fair value gaps step by step. Now, let us build your complete step-by-step process for trading fair value gaps. Step 1. Identify the higher time frame trend. Look at the daily chart first. Determine the overall direction of the market. Are we in an uptrend with higher highs and higher lows, or a downtrend with lower highs and lower lows? You want to trade gaps in the direction of this trend. Bullish gaps in uptrends, bearish gaps in downtrends. Step 2. Find and mark fair value gaps on your trading time frame. Using the three candle method we covered, identify and mark the fair value gap zones on your preferred chart time frame. Draw a box or zone from the high of candle 1 to the low of candle 3 for a bullish gap. From the low of candle 1 to the high of candle 3 for a bearish gap. Step 3. Assess the gap quality. Apply the strength factors. Is the gap large? Is it fresh? Does it align with the higher time frame trend? Is it near other significant levels? Only trade gaps that score well on multiple quality factors. Step 4. Set a price alert at the gap zone and wait. Do not watch the chart obsessively, waiting for price to return. Set an alert at the upper boundary of a bullish gap or the lower boundary of a bearish gap. When the alert fires, come back and assess the situation. Step 5. Look for a reaction signal within the gap. When price enters the fair value gap zone, you need a signal before entering the trade. Do not just buy blindly because price touched the gap. For a bullish gap, look for price to slow down within the gap. Look for rejection wicks forming at the lower boundary. Look for a bullish candle pattern forming. Look for a lower time frame structure shift from bearish to bullish within the gap zone. Step 6. Enter the trade with a defined stop and target. For a bullish fair value gap, your entry is at the confirmation signal within or just above the gap zone. Your stop loss goes just below the bottom of the fair value gap. If price closes below the full gap, the imbalance has been overfilled and the setup is invalid. Your target is the nearest swing high or resistance level above. Aim for a minimum risk to reward ratio of 1 to 2. If the gap is near a strong confluence zone, targets of 1 to 3 or better are very achievable. Step 7. Partial profit and trail stop. When price has moved significantly in your favor, consider taking partial profit at the midpoint target. Move your stop to break even. Let the remainder of the position run toward the full target. This approach locks in profits while giving the trade room to reach its maximum potential. Fair value gaps combined with order blocks and liquidity. Now let me show you how fair value gaps become even more powerful when combined with the concepts we have covered in previous videos. The most powerful trading setups arise when multiple concepts align at the same price zone. This is called confluence. And fair value gaps combined with order blocks and liquidity create some of the highest probability confluences available. Here is an example of how this looks in practice. The daily chart is in a clear uptrend, higher highs and higher lows. Bullish market structure confirmed. On the 4-hour chart, a bullish fair value gap formed during an aggressive move upward 3 days ago. Price has not returned to fill it yet. The gap is fresh and strong. Within that fair value gap zone, you can also identify a bullish order block. The last red candle before the aggressive move up sits inside the gap zone. This means the gap and the order block are overlapping. Double confluence at the same zone. Just below the fair value gap, there is a pool of liquidity. Equal lows from the previous consolidation sitting just under the gap zone. Now here is the scenario you are watching for. Price pulls back toward the fair value gap. As it approaches the gap, it briefly sweeps below the gap and takes out the liquidity pool below it. That is the liquidity grab. Then price snaps back up aggressively into the fair value gap zone where the order block is also sitting. You now have a liquidity sweep combined with a fair value gap entry combined with an order block reaction all happening in the same zone within an overall bullish market structure. That is 4 layers of confluence. That is an institutional grade setup. And that is the type of trade that gives you a truly exceptional risk to reward opportunity. Let me bring this all together. A fair value gap is a 3-candle pattern that forms when price moves so aggressively that it creates an imbalanced zone where the market did not have proper two-way trading. Markets have a natural tendency to return and fill that imbalance before continuing the original move. To identify a bullish fair value gap, find the gap between the high of candle 1 and the low of candle 3 in a 3-candle sequence with an aggressive middle candle moving upward. To identify a bearish fair value gap, find the gap between the low of candle 1 and the high of candle 3 in a sequence with an aggressive middle candle moving downward. Strong fair value gaps are large, fresh, aligned with the higher time frame trend, and located near other significant levels like order blocks or liquidity zones. Your trading process is systematic. Higher time frame trend first. Find and mark the gap. Assess quality. Set an alert and wait. Look for a reaction signal. Enter with stop below the full gap and target at the next significant level. And the most powerful setups combine fair value gaps with order blocks, liquidity sweeps, and clear market structure. Multiple confluences at the same zone create the highest probability trades you will ever find. If this video gave you a clear understanding of fair value gaps, please hit the like button and subscribe. Share this with one trader who is still trying to understand why price moves the way it does. Drop a comment below and tell me this. After learning about fair value gaps today, go look at a recent chart of any coin you trade. How many fair value gaps can you spot? Tell me what you find in the comments. I will see you in the next one.